This is Andy Hecht from Option Hotline. We're here today for a podcast where we're going to discuss trading philosophy with Todd Bubba Horwitz. I am the editor-in-chief of Option Hotline, and Bubba is one of our esteemed contributors on the site. Just a little bit about me. I ran trading desks in commodities for many years for Fibro, for Philip Brothers, for Fibro, for Solomon Inc. I worked running trading and marketing from the early 1980s to 1997 for that company. Then I went on to work for a number of banks and hedge funds, ran a number of businesses, ran the global bullion business for Philip Brothers, ran the sugar business, the nickel business, was involved in oil and natural gas and a whole host of commodities on the physical side as well as on the derivative side. Worked for banks, hedge funds, and most recently I've been one of the leading contributors on Seeking Alpha in the first top three in gold and precious metals, in foreign exchange, and in commodities. And now I'm the editor-in-chief of Option Hotline. And Bubba Horwitz has 4 decades of experience. He's a market maker for many years, one of the original market makers for SPX. And what's the best thing about Bubba is a trader's trader. And he really understands markets. Bubba and I come to the markets from a different viewpoint. Bubba's more of a short-term kind of orientation to the markets, whereas I'm kind of medium or long-term. So I think you'll find this presentation interesting, coming from the 2 different perspectives in terms of our philosophies to the markets. Well, welcome, Bubba. How you doing today?
What's up, Andy? Your great column again, as always, in Seeking Alpha. I love reading it. Always look forward to it. And, you're one of the best at it, and I love your insight. And what do you mean I'm a short-term trader? You mean 4 minutes isn't a long-term capital gain?
Well, it's all a matter of perspective. Anyway, let's get into it. We'll talk a little bit about philosophy. Why don't you start and talk to the listeners, the viewers, about how you view markets, what your calculus is in terms of approaching markets, and then I can do that, and then we can kind of have a discussion about it. So take it away.
All right. Well, first of all, I mean, to me, the news means nothing. I've been in this business 40 years. I've never read the Wall Street Journal. And if there's baseball on, I would watch it over anything else. The only time I watch the media is when I'm on myself. Okay. So other than that, I'm not a watcher. I don't want to see it because it's first of all, that news is always late. So and you always got to trade to price action. And again, I trade, many different models from hedging my portfolio, which is long-term, which I never sell out of, to as short as 4 minutes in time. Now, again, there's certain action that you're looking for in markets to get that reaction. But, again, I'll trade anything under any time frame as long as it's liquid, as long as there's an opportunity, and as long as it meets the specifications of the different patterns that I like to trade. Because at the end of the day, we know one thing, Andy, it always comes back to price. And price determines what's next. We can talk about certain levels. We can talk about what should happen. But at the end, price decides markets. And it doesn't matter what you're trading. It doesn't matter what time frame you're trading on. Because at the end of the day, all charts are the same. All patterns repeat themselves. And before you can get a change in trend, it's got to start with the shortest time frame.
That's absolutely no question about it. And certainly, that's a part of my philosophy as well. But I look at markets, I come at markets a little bit differently. I use what I like. First of all, Bubba, as he described, looks at markets in a, short-term orientation, intraday, maybe once in a while overnight. Well, just before I go into mine, what's the longest term trades you enter in?
I carry 24 commodities overnight, okay, that I'm trading, that I'm always in. I'm in a group of commodities that are either long or short, always. I'm never out of them. I'm in, from orange juice to gold, S&P to whatever. I'm in those markets every day of my life, okay, either long or short. And again, there's times I've been in the same position for 6-7 months. It depends on the trend. I mean, it's a trend trading proprietary algorithm that I use that if the trend is as long as the trend lasts, I hate when I have to change the trade, because that means either I'm taking off a profitable trade or I'm reversing a loser. I like it when I don't have to make any changes. It just every day I look at do I have to change? No, oh great. It means I'm making money. It's going to continue. So I'll carry trades for, listen, forever. I mean, I've got every day, for one thing for sure. I got 24 trades on, regardless of what I do during the day.
Perfect. So what I do is I use what I would call a technomental process. I'm very much a fundamentalist. I mean, I come from a world where I started at Phillip Brothers transporting commodities around the world. So I learned a lot about the traffic business, learned a lot about the physical aspects. So supply and demand analysis is really important to me. Inventories, supplies, demand, what's going on. And that all goes into some macroeconomic assumptions. So I come up with my price direction bias from the fundamentals. But I do use those technicals and the charts for entry and exit. So I look at markets. I have a kind of a 3-step plan that I look at. The first thing I do is I look at the fundamentals and I decide my directional bias, if it's long or short or flat. And a lot of times I'm flat in markets if I don't see anything that's particularly compelling. I look a lot at pricing cycles. When the price of a commodity or an asset will go beloh the production cost, that's kind of a screaming buy. When it goes too far above production cost and production accelerates, that's kind of can be a sign of a top in a market. So I come up with a plan. And the most important, the step 2 is risk reward. I mean, discipline and risk reward are the most important things for me. I rarely get into trades where I'm looking to risk $1 to make $1. I'm usually looking for the skew to be in my direction. Look.
Can I interrupt you for a second? I mean,
yeah, sure.
I think no matter what kind of trading you're doing, you're looking for, first of all, patience and discipline are the only way you can ever really make money in this business. Because if you try to be too rambunctious, typically you're going to get killed, right? I mean, you have to be patient enough and disciplined enough to wait for what you're trying to get. So, I mean, goes without saying, and you have to learn how to repeat the same process so that you can understand what your win rate is anyway, so you can put yourself in a better position no matter what time frame you're trading on.
Exactly. Bubba, the best analogy that I like to use is you talked about baseball. You like to watch baseball. I do as well. And no batter in the Hall of Fame ever batted 1,000. No trader is ever going to get every trade right. If you have an average over 300, you got a pretty good chance of getting into the Hall of Fame. In the world of trading, if you get it right half the time and you're not a successful trader, there's something wrong with your plan. You're not judging. You're not putting together risk reward. You're not using discipline. You're letting winners. You're taking profits too early on winners. You're letting losers run. And those are the cardinal sins. For me, the cardinal sin is letting a winning trade turn into a loser. Right. So that all goes into the risk reward. It goes into plan, and it's really, really important. The third thing that I always remember that's really important to me, I'm always reevaluating, as I'm sure you are on your trades. I always remember that I'm long or short, not at my execution price, but at the last tick on the screen, because that's the price where buyers and sellers are meeting. That's the right price. I used to have traders come to me and say, oh, the market's wrong. I would say the market is never wrong. The market is always right.
I mean, that's the price. And you mean to tell me that you don't say that once you're like winning on a trade that you say, oh, I'm playing with house money? You actually mark it where it's at so you know exactly where you stand?
I do. I really try to put that discipline in. I want to test myself at every level and make sure, especially, Bubba, because I'm a fundamentalist. I want to reevaluate. It goes into my process. I want to make sure that we're not moving too far away in a pricing cycle, something that initiated a trade. If I'm looking, let me take an example here. If I'm looking, for example, at the coffee market, and I believe that coffee is at the bottom of the pricing cycle, and there's a lot of things that go into coffee. The Brazilian real is very important because Brazil is the largest producer and exporter of Arabica coffee beans in the world. If the coffee market moves, I want to know why it moved. And I want to make sure that, I'm using the same investment calculus, the same plan at the current price that I did when I entered the trade. So I'm constantly reevaluating my thing. So always, always understanding that the last tick is the right price and reevaluating your original thesis is important to me.
I agree. Listen, I couldn't agree with it. I do the same thing, except I'm just determining on price. And at some point, if I'm trading on a short term, then at some point it's gonna show me that it's time to get out, because it's gonna stop me out, because I'm gonna continue to read the market. I'm gonna continue to read the price action, and it's gonna get to a certain point as I move my stop up based on where we are. And then of course eventually it will maybe take me out. Now again, I don't get out in a hurry. And I think that's the number one flaw with everybody, is they're willing to take a trade and you make $100, whatever. Boom, they get out and take their money, but they'll hold this one for a $3,000 loser until it comes back. And that's not the way. If you're defining the type of trader you are, and if you're day trading, then that means you're day trading. That means you're not turning a trade into an investment. It means you need to learn how to let your profits run and close the dogs, because that's why you use stops in this business if you're a short-term trader.
Absolutely. Absolutely. When I first started in the business in the early 80s, one of my first bosses told me that you have to always remember that you want to eat like an elephant and poop in like a bird. Most traders, they eat like birds and, leave elephant-sized losses. So you really need to be careful of that. And that goes to exactly what you're saying there. I talked a little bit about my orientation towards fundamentals, which comes from supply and demand. When it comes to the technicals, all entries and exits into positions come from the technicals, because I'm a strong believer in the wisdom of crowds and herd behavior. And what the charts tell us is where the herd is stampeding. And there's nothing more important than sentiment in a market.
Listen, I agree. I personally, a lot of the stuff I like to do short term is I like to trade the panics up or down. I like to sell into them or buy into them, because that's very common. And what do we know for sure when the market's going parabolic on heavy volume?
Right.
Somebody's got a tap on their shoulder, they're getting blown out, or somebody's just puking out. It doesn't matter. So it's easy to take advantage, because they're creating, it's the old days we used to stay on the floor. When you can see somebody's tonsils, they're wrong.
That's right.
Because they're wrong.
That's right. One of my bosses was Andy Hall, the world famous oil trader. And he used to say that he would walk around the trading room and look for the traders on the desk who were turning green and that's what would trigger a lot of his trades. It's exactly what you're saying about the tonsils.
No, I mean, look, if this is one of the things about being on the floor, is you have to be willing. You're in a game. You're playing in like a poker. It's like a big poker game. If you show emotion on the trading floor, you will get hammered. Okay, they will come to you like flies to and they will pound you away, because again, that's why you have to be able to win or lose. You have to have the same expression at all times as you're trading, because you're playing in a game against others. Let's be honest, okay? We're competing in the business of trading, investing. You're competing against others for a price, a product, and what's going to happen next.
Exactly. That's exactly right. Well said. So, you grew up on the floor. You learned your craft on the floor. I learned my craft upstairs. So a lot of the orders that I put, that I would do when I use the exchanges, I use the over-the-counter markets tremendously, but I use the exchanges equally. One of the big issues that's been facing markets is the trend, and you and I lived through it, Bubba. The floor, the open outcry system changed to a totally electronic system. And now there's a lot of court cases out there about spoofing. And I wanted to talk to you a little bit about that and philosophy and explain, maybe explain from an upstairs trader and a floor trader's understanding of what's really going on. Because a lot of people are confused about this whole spoofing topic, and the Justice Department, the CFTC, handed down a whole slew of indictments, particularly in the precious metals arena, over recent weeks, months, and years over spoofing. So I wanted to get your kind of take on how you view this whole situation. And then I'll kind of chime in as well.
That's because I got nothing else to do. I mean, that is the most ridiculous thing ever. I mean, look. Spoofing is a part of trading. You spoof in anything that you ever sell. If you're a salesman, you're spoofing your client to buy something. You're selling your house, you're spoofing the price. That's what makes it a competition. Okay. It's the ability to read that competition and understand where these people are coming from. Listen, if they put a bid in, okay, and it's spoofing the market, if somebody whacks that bid right away, they're going to get filled on part of it. They can't get away from it. I mean, we know they cancel and replace. In fact, years ago, the CME took out that feature of the automatic cancel replace. If you had too many of them, they would fine you, because again, they were trying to prevent it, which is fine. But you can get hit on, you can spoof, but you can also get hit on that order if you're trying to create something that's not there. But there's one thing that we always know is that markets go to size no matter what. So if somebody's showing a real big bid, what does that mean? It means they're probably looking to be a seller. They're trying to hold up the market with a big bid, and the people that look at it, oh, geez, someone's buying it, I'm going to go run and buy, and they get them to buy. So they're really, what they're doing is they're selling them on the other side. That's perfectly legit in my book. I mean, that's part of the market. If you can't understand that, then that's the problem that goes on. I can't worry about that problem. I don't look at it as anything wrong. There's a lot worse things that have been done over the years, including the dual books that they used to be able to carry. They were a broker and a trader at the same time. That was worse than any kind of spoofing.
Right. So the way I look at this spoofing thing, spoofing started. It really started because of the relationship of me, the upstairs trader, and you, the broker on the floor. So what used to happen is I would be a market maker to the over-the-counter market. I would get hit or taken on a bid or offer that I would put out there. I would go to hedge that position on the floor. And if it was a sizable position, my floor broker, when there were those dual trading books, if I said sell 1,000 gold at the market, they'd sell their 10, 20, 30, maybe 50 lots ahead of mine, and then fill me fill themselves out of the last selling that I would do. And, the bottom line would be that, it would be annoying for me as the upstairs trader. It would be risk-free money, really, for the person on the floor. Nothing is risk-free, but it would be as close to risk-free.
That was risk-free trading. That was the problem. That's why I don't understand how that ever got over. That was risk-free trading. I'm holding the order. I can go in the open market and get myself and have you fill me.
Exactly. So what we would do is we would wind up spoofing our brokers on the floor. We wouldn't say sell the 1,000. We might say buy a couple of hundred before we went and sold on the floor and sold to the other dealers. So what happened was the advent of electronic trading changed the whole dynamic dramatically. And also the 2008 financial crisis, Dodd-Frank, a whole bunch of rules. A lot of the people who are getting indicted these days are getting indicted because they really didn't change. They kept the old school way of doing things. I think that they didn't adapt with the times.
And again, I don't see what they have to adapt to. I mean, again, I don't see what they're doing is wrong. I mean, look, I guarantee you, I'm not going to name banks because we don't need a lawsuit.
Right.
I guarantee you the big banks are doing it every day. Okay. They did it when I was on the floor. They would have one broker on one side of the pit and get the momentum rolling, and then on the other side was cracking you. Okay, it happens every day.
I agree. And by the way, we're not just talking about the gold and silver markets, which are the focal point for these indictments and so on and so on. This happens in everything.
Foreign exchange across the world.
Every asset. And by the way, the other mistake that we make as the United States, the Justice Department, the CFTC, we sometimes take a very parochial view that, we make the laws for the world. These markets are global markets. If you think, I've done a lot of business over the years with the Chinese, with the Russians, if you think that they're not the biggest spoofers in the world, then you got something coming to you.
I mean, what about OPEC? Are they not criminals?
Right. Well, you talk about price manipulation. One of the charges here are price manipulation. I mean, a cartel by its definition manipulates the price. Right. There's another example. When Amazon decides to go into a new business and with their capital base, they decide they go in and they decimate all of the, is that market manipulation or is that just capitalism?
Well, I think it's probably a little bit of both.
But it probably is.
That's the free market, baby.
It's the free market.
They don't have to be successful at what they do. They happen to be, but they don't have to be.
Right. The bottom line, though, is that, we have to realize in the U.S. that there's another rest of the world out there, and that a lot of the rules that we make for our traders, for our market, for our producers, for our consumers, for all of the market participants, we don't want to put ourselves in a position where we're in a submissive position to the rest of the world. China will continue to spoof, to manipulate markets to their benefit. Look, they bought the LME, the London Metals Exchange, right? One of the biggest games on the London Metals Exchange is if you take a large position, you either put a lot of stocks in or you take a lot of stocks out, and you move them, you hide them. For us to think that would be an illegal thing under Dodd-Frank. To think that China, Russia, and other countries around the world don't do that, well, it's kind of naive.
It's the same thing as when we heard about China's currency manipulation. Okay, are we not currency manipulators ourselves? Did we just not recently add another QE program to lower the value of the dollar? I mean, come on, let's be real. They're all doing the same thing, including us, Dodd-Frank or no Dodd-Frank. Okay, the government does it all the time. The Fed does it all the time. This is part of the business. Okay, that's recognizing what's going to happen next.
We do it in the interest of stability.
Yeah, I know. I don't buy that bull.
I don't either. We do it in the interest of vested interest. That's the bottom line. I mean, but listen, governments are the biggest manipulators. There's no question about it. I mean, they have to be. They have to be.
Why else would they want a central bank?
Exactly.
I mean, we get that another conversation another day, but I mean,
exactly.
Markets themselves, it still comes down to the same thing. You're looking for a fundamental reason to buy something, but you want it to be technically timed to buy it. I mean, if it's fundamentally strong, but it's way out in Pluto and you're going to buy it, you're going to wait to see if it sells down a little bit before you chase it. You're not going to chase it up, right?
Right, exactly.
So we and I are doing the same thing. We both work off a price. You work off a fundamentals before you want to get in. I'll trade them as often as I can if it fits the right price pattern. It doesn't matter. We're both the same, but different.
That's a great way to sum it up, really. I mean, I look at pricing cycles. You look at price cycles. So it's a different orientation, but it's very synergistic. No question about it.
We got synergy, baby.
That's it. Well, I really want to thank you. Like I said at the beginning, Bubba is a trader's trader. And, there's a lot of pearls of wisdom in his advice. And, I'm looking forward to doing a lot more of these together with Bubba over the coming weeks and months. And, I hope everyone enjoyed our little podcast today and look forward to seeing you all out there again real soon. Thanks, Bubba.